What triggers the most devastating financial crises? The ones that don't just stop at a bubble bursting but collapse entire economies. Imagine waking up to a stock market crash, watching your investments vaporize, and realizing your savings are at risk. Sounds terrifying, right? It's happened before. The 2008 crisis saw mortgage delinquencies skyrocket by 657%, wiping out $691 billion in losses from Lehman Brothers alone. The Great Depression left 25% of the workforce jobless, with pay cuts averaging a brutal 42%. These financial meltdowns didn't come out of nowhere, they had warning signs. In today's video, I'll uncover the key indicators of an impending financial crisis, show you how to spot them, and share what you can do to protect yourself. But before we dive in, smash that like button and subscribe for more insights into the truths about finance. Let me know in the comments, do you think we're heading for another major financial crisis, or is this just another run-of-the-mill recession? Let's talk about it. To understand a financial crisis, we first need to distinguish it from a bubble or recession. A bubble bursting happens when an overvalued asset collapses. Think of the dot-com bubble of the late 1990s, when tech stocks soared despite having no real profits or business plans. When reality caught up, stock values crashed, but it didn't destroy the entire global economy. A recession, on the other hand, is an economic slowdown. It's painful, but manageable. Typically, a recession is defined as 2 consecutive quarters of negative GDP growth, and central banks can often soften the blow by reducing interest rates. But a financial crisis? That's a whole different beast. It's not just a downturn or an asset crash, it's an economic meltdown that leads to systemic collapses. Think 2008, when the housing market imploded, or 1929, when the stock market crash spiraled into the Great Depression. Here's the difference: it's debt. When bubbles and recessions are driven by debt-fueled buying frenzies, they don't just pop, they explode. So, what creates a financial crisis? There's always a pattern. 1. Bubble-like asset inflation. People pour money into something they think can only increase in value. 2. Debt-driven buying. When loans fuel the frenzy, the stakes skyrocket. 3. Sudden loss of confidence, buyers vanish, prices plummet, and those holding debt are left unable to pay. Take 2008, for example. Everyone thought housing prices would keep climbing. Loans became easier to get, fueling a massive surge in home buying, even by people who couldn't afford the payments. When the market turned, it wasn't just homeowners who got crushed. Banks, investors, and entire industries collapsed. Recognizing bubbles isn't as hard as you might think. Speculation drives them, and history gives us clear examples. Tulip mania, 1600s. In the 1600s, tulips became symbols of wealth. Futures contracts on tulips, yes, tulips, led to wild price speculation. When the bubble burst, people realized they had spent fortunes on flowers that had no intrinsic value. Dot-com bubble, 1999. In the late 90s, everyone was buying stocks like whatever.com, ignoring fundamentals like profits. Coffee shop chatter about the next big stock was a major red flag. Housing market bubble, 2008. Remember the scene in The Big Short? The stripper bragging about owning multiple properties she couldn't afford? That's the kind of craziness that signals a bubble. The lesson? When even the stupid money starts investing and borrowing to do it, it's time to get cautious. Debt turns bubbles into crises. Why? Because when values fall, borrowers can't repay their loans, creating a domino effect. For example, 1. 1929. Margin trading fueled a stock buying frenzy. When the market crashed, borrowers couldn't repay their loans, leading to bank failures and a global economic collapse. 2. 2008. Subprime mortgages allowed anyone to buy homes. 3. When the housing market collapsed, foreclosures skyrocketed, and banks holding bad loans imploded. Without debt, bubbles pop quietly. With debt, they destroy everything in their path. One reliable tool for spotting trouble is the Leading Economic Index, LEI, published monthly by the Conference Board. The LEI tracks 10 economic indicators, like unemployment claims and stock prices, to forecast recessions. When the LEI starts dropping consistently, it's a red flag. Combine that with speculative behavior, like people rushing into Bitcoin, tech stocks, or real estate, and you've got the makings of a crisis. Let's look at how these patterns played out historically. The Roaring Twenties, the economy boomed, fueled by credit and consumer demand for homes and cars. Stocks soared on borrowed money, creating a bubble detached from reality. When it burst, the inability to repay loans triggered the Great Depression. 2008 financial crisis. The housing market was seen as safe, leading to risky loans and speculative buying. When prices fell, homeowners defaulted, and banks collapsed. The key takeaway? When speculation meets debt, the fallout goes global. So, how can you safeguard your finances against the next financial crisis? Diversify your investments. Don't put all your money in one asset class, like real estate or tech stocks. A balanced portfolio reduces risk. Watch for speculation. If everyone's talking about the next big thing and borrowing to buy in, it's time to stay cautious. Avoid overleveraging. Don't take on debt to invest in speculative markets. If prices drop, you'll be left holding the bag. Keep an eye on economic indicators. Track tools like the LEI and consumer confidence reports to spot early warning signs. The patterns are clear. Speculation fuels bubbles, debt turns them into crises, and risky behavior magnifies the fallout. Take the housing market crash of 2008. 1. Risky loans flooded the market. 2. Homebuyers took on debt they couldn't afford, assuming housing prices would rise forever. 3. When prices fell, nearly 250,000 homes were at risk, delinquencies surged by 667%, and the global economy nosedived. The scary part? No one acted to prevent it. The lesson? It's up to you to protect yourself because history shows no one else will. Can we predict the next financial meltdown? Not exactly, but there are always warning signs. Speculative bubbles in assets like Bitcoin or gold. 1. People buy, not because of inherent value, but because they believe someone else will pay more later. 2. If you hear, it can only go up, run. Debt-fueled buying frenzies. 1. Borrowing money to buy speculative assets multiplies the risks. 2. If you're holding debt, avoid risky investments like the plague. The takeaway: if everyone's chasing the next sure thing with borrowed money, a crash is brewing. Today, financial cycles move faster than ever. Information spreads instantly, herd behavior kicks in, and markets react at breakneck speed. While we're not currently in the kind of reckless borrowing environment that led to the 1929 crash or the 2008 meltdown, speculative bubbles in certain sectors, like tech stocks or cryptocurrency, are raising eyebrows. Preparation starts now because cycles are speeding up, and the next financial crisis could happen far sooner than anyone expects. Here's a key insight: bubbles are illusions fueled by FOMO. When everyone's chasing the same trend, ignoring fundamentals, you know a crash is on the horizon. For example, 1. GameStop stock frenzy. A clear case of herd behavior driving up prices far beyond intrinsic value. 2. Real estate companies with unrealistic valuations. If a company's market cap is bigger than global leaders like Max, it's probably a bubble. Pro tip: it's okay to take small, calculated risks, but avoid following the crowd blindly. Never bet your entire portfolio, or worse, borrow money, on speculative trends. If history is any guide, another crisis isn't a question of if, but when. Here's how to protect yourself. 1. Diversify your portfolio. 1. Spread your investments across asset classes, stocks, bonds, real estate, and commodities. 2. Consider Ray Dalio's all-weather portfolio. 2. It's designed for long-term stability, even during market downturns. 2. Avoid debt-fueled investments. 1. The number one factor that turns bubbles into crises is debt. 2. If you're buying a home, aim to pay it off as quickly as possible. 2. Avoid using debt to buy speculative assets like Bitcoin or gold. 3. Recognize FOMO. 1. If friends and family are raving about the next big thing, take a step back. 2. Ask yourself, is this asset fundamentally valuable, or is it just hype? 4. Educate yourself. 1. Financial literacy is your ultimate shield. 1. Read classics like The Intelligent Investor or Think and Grow Rich. 2. Learn from history to avoid repeating it. History provides clear warnings, the Roaring Twenties and Black Tuesday. 1. Everyone believed stocks would rise forever, leading to reckless margin trading. 2. When the bubble burst, borrowers couldn't repay their loans, triggering a global depression. The housing crisis of 2008. 1. Easy credit and overconfidence in real estate created a perfect storm. 2. When prices collapsed, homeowners, banks, and the global economy were dragged into a downward spiral. Tulip mania, 1600s. 1. Tulips became symbols of wealth, leading to speculative futures contracts. 2. When the bubble burst, fortunes evaporated, leaving a valuable lesson. Speculation without fundamentals leads to disaster. Your secret weapon is exactly what you're doing right now, educating yourself. Financial literacy isn't just a skill, it's a shield against becoming a victim of the next crisis. Spend 10 to 15 minutes a day learning about investing, risk management, and market history. And remember, the next crisis might look different from 1929 or 2008. Yesterday's tulips could be today's Bitcoin, or tomorrow's housing bubble. The key is recognizing the patterns and preparing before disaster strikes. To sum up: 1. Speculation fuels bubbles. 2. Debt turns them into crises. 3. Financial literacy is your best defense. The next financial crisis isn't a matter of if, but when. Spot the signs, avoid risky behavior, and act on the lessons of the past to safeguard your future. If you found this video helpful, smash that like button, subscribe, and check out these other videos about economic history and how to prepare for recessions, depressions, and market crashes. Stay informed. Stay prepared.